Exxon had the larger quarter in absolute dollars, but Chevron executed better relative to expectations. For capital allocation, I would give Chevron a slight edge for balance sheet discipline and near-term incremental returns, while Exxon has the stronger case for large-scale, long-duration reinvestment. Exxon's larger profit is partly a scale effect. It produces more and reported revenue of approximately $116 billion versus Chevron's roughly $70 billion. But Exxon's adjusted EPS missed expectations, while Chevron exceeded consensus by approximately 9%. Why Chevron looked better operationally? Chevron increased production to about 4.07 million barrels of oil equivalent per day, compared with roughly 3.9 million barrels of oil equivalent per day in Q1. Exxon remained the larger producer, but its output declined from approximately 4.59 million barrels of oil equivalent per day in the prior quarter. That distinction matters. Exxon earned more money, but Chevron demonstrated better sequential volume momentum. Chevron also benefited from the Hess acquisition, especially through production growth in Guyana and the resulting cost synergies. Chevron's downstream business was also a major swing factor. Refining earnings rose to about $4.9 billion, compared with approximately $737 million a year earlier. Exxon's downstream earnings were slightly higher at $5.5 billion, aided by record diesel production, but Exxon had a larger quarter-to-quarter recovery from a first-quarter downstream loss. Chevron reduced debt by approximately $8.4 billion, compared with more than $7 billion for Exxon. Both companies were conservative despite unusually strong commodity prices, but Chevron's debt reduction was slightly larger in absolute terms. That is particularly notable because Chevron is the smaller company. It suggests management is using the Hess-related cash generation to strengthen the balance sheet rather than immediately maximizing buybacks. Exxon returned approximately $9.4 billion to shareholders during the quarter, compared with about $6.5 billion for Chevron. Exxon therefore returned more cash in absolute dollars, although it also has a larger equity value and a larger cash-generating base. Exxon's approach is more shareholder return-oriented at scale, continue funding major projects while maintaining substantial dividends and repurchases. Exxon's stated long-term plan calls for approximately $28.33 billion of annual capital expenditure during 2026-2030, focused on advantaged oil and gas projects, refining, chemicals, and lower carbon businesses. The company says its objective is to grow earnings and cash flow while reducing its reinvestment rate over time. This is a higher spending strategy than Chevron's current $18.19 billion annual capital budget. Exxon is therefore making a larger absolute bet on future growth, while Chevron is operating with a somewhat smaller and more focused investment program. For this quarter, I prefer Chevron's execution. It beat expectations, increased production sequentially, generated substantial cash, and reduced debt aggressively. For long-term capital allocation, the answer is closer. Chevron appears more disciplined, while Exxon is potentially more powerful if its large investments generate the returns management expects. In investor terms, Chevron is currently the cleaner capital allocation story, Exxon is the larger compounding platform. But I would not annualize either company's Q2 earnings because both benefited from unusually high oil prices and refining margins.